Following Mark's speech, I'm going to start with something that I cut out of my talk because I didn't have enough time, but I think it really talks to a lot of what Mark was talking about. And it's from a McKinsey's article called Redefining Capitalism. If you haven't read it, it's very short and it's a good read. But a couple of things that I took out of that were prosperity in a society is the accumulation of solutions to human problems. Growth represents improvements in lived experience and the rate at which new solutions to human problems become available. And in the article, McKinsey's talk that we've really lost the plot a little bit in terms of capitalism and our almost myopic focus on capitalism's role in terms of allocating capital rather than on its other benefits. And they say the genius of capitalism is that it both creates incentives for solving human problems and makes those solutions widely available. So, I think that talks a lot in terms of the broader role of business in terms of our society. So, there's a clicker here, and apparently I do. Not sure what I do. I'll use that one there. So I'm going to talk very quickly about where we are today in terms of global environment and S&P's outlook for the next 12 months. I'm not going to spend too long on it because I suspect that Warren will be covering a lot of that material, and on the economics front he'll do a much better job than me. Talk a little bit about what we see as the top global risks to that outlook. Global credit conditions, touch on those very quickly, and then really change gears and move forward in terms of longer term trends and the implications of those trends and risks and opportunities for Australia. So in terms of the global economy, it continues to expand, but growth paths are diverging, and unfinished business in the global economy poses downside risks to the base case. So in terms of that unfinished business, some semi-permanent scars from the GFC, the architecture of the Eurozone, Japan's deflation, and rebalancing of the Chinese economy from, as John mentioned, from an investment-driven economy to more of a household consumption-driven economy. So fairly big risks. Overall, we're seeing that global growth is going to be led by increasing momentum in the US and a moderating of growth in the UK and, importantly for our region and Australia, China. Monetary policies of major central banks are parting ways in 2015. So under the threat of a triple dip recession in Europe, which we currently have pegged at about 25% probability, the ECB has boarded the QE train. The Bank of Japan's in full-fledged balance sheet expansion mode, but the Fed and the Bank of England look like they're about to start reining in their super easy money. Inflation still generally below target, so disinflation is an elevated concern for Europe, and of course in Japan the jury's still out on whether Japan's valiant bid to end secular deflation will succeed. When I talk about this with our global chief economist, he remains somewhat optimistic about monetary policy's ability to do this. I'm a crusty credit analyst. I look at the culture and the demographics and say, I don't think so. While inflation's generally looking on the downside, the interesting thing is that with QE, what we have is pretty much synchronised asset price increases across geographies and sectors. And as John mentioned, that's really exacerbating the increase in inequality within countries. We also have heightened volatility, so geopolitical risks, commodity prices, the spectre of the Fed monetary policy normalisation and our high debt, low growth world. So the great deleveraging since the GFC has landed us in the situation where we have more debt than we started with pretty much across the system. Global economic outlook. So in the US, we're seeing growth momentum increasing, and that's a positive. Europe, flat and pretty dire. And in Asia Pacific, still growing, but really the momentum is slowing down. Here I'm just going to pull out a couple of things that are probably of more interest to me on the credit side and leave the economics to Warren later on. So in terms of the US, I think one of the really interesting things that's happening is what it means to the US relationship and role in the Middle East of a more energy self-sufficient US. In Europe, in terms of their recovery prospects, for us, we cannot identify what the medium and long-term drivers back to sustainable growth look like. Europe has an ageing population, probably second to Japan in terms of the timing of those demographics. That's going to be a drag on output and spending for the foreseeable future. And with QE and the measures that have been taken since the GFC, what we're seeing is a wealth transfer from the traditional spenders in the economy to traditional savers. So the longer that environment and this current environment continues, the higher the chances of instability, economic, social and political, and we're starting to see that, and the less likelihood of debt actually being repaid, and the higher the likelihood that we start to see debt restructuring. And, I think it is important to think about the human element of some of what's going on in Europe. In Greece, I read a report that Doctors Without Borders are actually operating in Greece and handing out food parcels and vitamins because, adults and children are basically malnourished. And I think that that's pretty phenomenal in terms of, that's not what we expect in a country like Greece. It's sort of what we expect when we hear stories about Africa, but the austerity measures are having a significant impact on life. The other issue from our perspective on the credit side is that with the ECB's asset purchase program, if that's actually unsuccessful in stimulating growth, that could erode market confidence even further and cause a spike in sovereign bond yields in the region, which is obviously going to have the exact opposite impact that they're looking to. In Asia Pacific, China's growth is slowing. The investment boom and commodity super cycle are coming to an end, and we're likely witnessing a structural rather than a cyclical shift in commodity prices. China will face its own issues in terms of demographics and peak labour force. So, these are long-term shifts. 2015 and 2016 for Asia Pacific on the economic front look a little bit stronger, but the balance of risks are tilted to the downside, particularly given the uncertainty remaining in the Chinese property market adjustment. As the US starts to normalise their interest rates, we're also going to find out how a new cohort of borrowers raised on ultra-cheap credit behave as interest rates go up, and I'll talk a little bit more about some of those countries in a little while. I think the one positive, often seen as a negative with Asia Pacific given its dependence on importing energy, in particular oil, is that the recent fall in oil prices is a windfall for most of Asia Pacific and may be a timely boost to GDP, but that really depends on expectations and whether those savings, whether that windfall's spent or saved. So in terms of top global risks, geopolitical risk, inherently difficult to predict, and perceptions oscillate wildly. Most geopolitical flashpoints at the moment we would see as being non-systemic in that they're likely to be contained regionally, although we'd see the Russia-Ukraine crisis as being the exception to that rule. We really don't have any precedents in terms of what the impact of sanctions on a country as big as Russia might be, and particularly when we consider that the role that Russia plays in providing a lot of Europe with its energy needs. Credit market volatility from US Fed policy normalisation. We are expecting rates to increase and that we will see elevated spread volatility in credit markets in 2015 compared to 2014. Raising interest rates will likely have a bigger impact outside the US than it does inside the US. So countries with their currencies linked to the US dollar, such as Hong Kong and China. Countries with higher external fiscal deficits may experience short-term funding stress due to capital outflows. And for those economies that have increased their leverage significantly in recent years, such as Korea, Malaysia, Singapore and Thailand, they may experience more significant asset price corrections if global interest rates rise faster than expected and have difficulties refinancing debt. Eurozone stagnation and the prospect that disinflation morphs into deflation, and unexpected turbulence in China's financial sector stemming from a repricing of risk, and in particular the property sector, which is facing oversupply and slower demand. So credit conditions in the US, the mostly stable credit conditions could suffer from a repricing of credit risk in fixed income markets during 2015, but also they've gone to the top of the mountain and they're on the other side of the credit cycle. So we're seeing rising corporate leverage, easing loan underwriting standards and growing auto and student debt. In Europe, credit conditions continue to ease, predominantly because there's low demand for credit, which reflects a weak business sentiment, uncertain economic outlook and stubbornly high private debt levels. And in Asia Pacific, we're starting to see slightly tighter credit conditions as investors and lenders start to reevaluate their risk-return strategies against a backdrop of slower regional economic momentum and indicating a possible less optimistic view by some and the turning of the credit cycle potentially. So, shifting to long-term trends and their impact and implications. Ageing populations and shifting demographics is a major theme. S&P produces demographic studies every 5 years, and in our last series we analysed the impact of ageing demographics, and in a significant number of countries we expect that that's going to start impacting sovereign creditworthiness from the mid-2020s, which when you think about the policy shifts and reforms that need to happen to counter that, is not very far away, because these are long-term changes that need to come into effect. We also have some significant changes in demographics, so global urban population and shift in wealth and economic power from east to west. We also see climate change being a significant driver of sovereign creditworthiness, and poor and lower rated sovereigns are typically going to be hardest hit. On the corporate credit side, we expect that regulators and investors will focus more on climate and carbon risks as an indicator of value and company performance, and increasingly climate events and carbon risks will impact on corporate credit quality. We had Aussie Super a couple of weeks ago in the paper calling on the major bank chairmen to explain how they're managing their carbon exposures. UniSuper's actually introduced a negative and positive screen option for their fund members, and in September we had a new super fund, Future Super, which is a fossil-free super fund launch in Australia. So we're starting to see some significant shifts in terms of investor focus. We also need to keep an eye on China. With over 20% of the world's carbon emissions, it currently has ETS pilots running in 7 regions in preparation for a launch of a nationwide carbon market. And we expect that that will actually lead to them becoming the price setter for carbon when that gets introduced. Technology, I think people have spoken about. There are positives and negatives. I think technology has been a major issue in terms of driving down between country inequality, which is a positive. But overall, the implications are driving social change. Policy investment decisions today increasingly need to be framed by longer term trends. We're starting to see shifts that some people may be thinking are secular structural shifts, but are probably masquerading as cyclical trends. And in terms of the implications for Australia, quickly. Risks are that China growth slowing, China investment and commodity super cycle coming to an end. We have a significant reliance on foreign investment capital, which means we do need a strong sovereign, we need a sound banking system, and we need to be an attractive destination for that capital. Strong reliance on fossil fuels, which we've benefited from significantly, but we need to start making the shift away from that. Ageing population and worsening terms of trade, household debt and widening budget gap. The opportunities, adversity is often the mother of all opportunities. So in some respects, the end of the commodity super cycle provides the burning platform for change and reform, hopefully. We need a clear vision for the future aligned with our values. I did feel somewhat empathetic towards Heather Ridout's call for the Normal People's Party, and it does bring to mind one of my favourite quotes from the Cheshire Cat, which is, "If you don't know where you're going, any road will take you there." I think we need to invest in education and creativity. You know, arts, I think, is often an underlooked part of the education system, and in combination with a stronger focus on STEM, I think that, you know, as a country, we are very, very fortunate to have such a diverse and multicultural society, and I think that given the skills we need for the 21st century, that's something that we should invest in and is a competitive advantage. And we have an opportunity. You know, we have the financial system inquiry out, the 2015 intergenerational report coming out, the Federation white paper, the white paper on tax. So you know, be brave, be bold and positive in framing the reform agenda. And, you know, I don't, in terms of the rhetoric in the press, you know, don't sell the Australian people short. I think we're better than that. I'm going to finish with two quotes. I know I'm running over time, but I want to say these quotes. My first is from Woody Allen. Current day social philosopher. More than any other time in history, mankind faces a crossroads. One path leads to despair and utter hopelessness, the other to total extinction. Let us pray we have the wisdom to choose correctly. And then jumping across the Atlantic and going back in time, I'm going to finish with an excerpt from an essay by Bertrand Russell, which appeared in the West Australian in 1950. So I guess it shows how deep culture runs in terms of changes. And he was musing on why Australians should be happy. There is no reason why you should not in time support a population of many millions of prosperous and happy people, except for the minority that some pathological ailment condemns to morbid misery. I guess that was his changeover with Woody Allen. I do not suggest that all this can be achieved easily. It will require a very large investment in scientific research, much of which will probably prove unfruitful. And when scientific research has successfully shown the way, it will require large and bold investments in capital. Perhaps you are all too comfortable to take so much trouble. Perhaps you will be content with a moderate and humdrum success, but I hope not. I hope the more adventurous and enterprising spirits among you will be inspired by a golden vision of a possible future and will be content to take the risks involved in aiming at a great success rather than acquiesce in the comfortable certainty of a modest competence. Thank you.